Thank you, Mr. Chairman, and thank you all for being here today. Thank you for calling this hearing. You know, homeownership remains the principal way for most families to build economic security. But access to mortgage credit is very tight. Only about half as many new mortgages were approved in 2012 as back in 2001, well before lending standards were loosened up in the run-up to the financial crisis. Now, Fannie and Freddie are responsible for a huge portion of the secondary mortgage market, and that means their standards have a major influence on what mortgages are actually offered in the primary market. Since the crash of 2008, trouble with a mortgage or a short-term job loss has left millions of Americans with dings on their credit scores. And moderate income families, African American and Hispanic families have been hit especially hard. But instead of taking that into account in loosening credit score standards, Fannie and Freddie have gone in the other direction. In 2012, the average credit score associated with a mortgage purchased by Fannie or Freddie was over 760. That is more than 50 points higher than the average credit score associated with the mortgages they purchased back in the early 2000s, and more than 50 points higher than the average credit score of the average American. To be blunt, Fannie and Freddie have put home ownership out of the reach of millions of credit-worthy families. So, Ms. Gordon, I just wanted to start with you. Do you agree that Fannie and Freddie's credit standards have played a key role in keeping many Americans out of home ownership?
Well, the answer is yes, but it's not just their credit standards per se. The whole direction of Fannie and Freddie policies since the conservatorship has been extremely conservative, not aimed at performing their chartered mission of serving all markets at all times.
Fair enough. I just wanted to focus in, though, in particular on credit scores. It's an easy piece to get hold of and an easy piece to talk with Fannie and Freddie about. We've got other aspects, I promise we'll
Sure. No, absolutely. On the credit scores, I mean, it's partly because of the overlays, partly because they're using the old FICO model, and, you know, with the heavy reliance on automated systems as opposed to manual underwriting, they have some important exemptions from some of the QM standards, but often are not able to use the compensating factors or don't want to use them.
That's right, and the data would suggest they're not using them. Right. And Ms. Guzmán, you're out there doing real estate. Would you agree with that?
Absolutely.
Okay.
Absolutely. There we go. Absolutely. When we look at the HAMDA filings in 2006, 56.8% of African American and black borrowers had an Experian credit score of 650 or less. When we're looking at FICO 9, this will result in increased acceptance of mortgage applications. But we also believe Vantage Score is another model that they need to be using. First of all, again, that number 650 or 675 does not indicate risk. It just means how much credit they have available to them. With Vantage Score, it takes into account rental payments, utility payments, and maybe even possibly with many Latinos in our market, they send their children to parochial school. That is a big nut they have to pay on education every month. They should be using other methodology and have innovation within the organization to actually look at this and say, yeah, we need to now expand the way we give credit or how we determine who is a credit-worthy borrower.
Good. I think that's really valuable and offering a lot of approaches that Fannie and Freddie could be using. You know, when Fannie and Freddie keep credit so tight, especially at a time when housing is more affordable than it has been before, then it is bad for families, it's bad for the housing market, and it's bad for the economy across the board. So I want to ask you about one other thing, and that is, since the government's Home Affordable Mortgage Program, HAMP, began in 2009, more than 1.3 million homeowners have received a loan modification. And many of these modifications reduced the interest rates, which in turn lowered the homeowners' monthly payments and helped people stay in their homes. About 90% of these modifications were designed so that interest rates would begin resetting and gradually increasing after 5 years. The first resets started last year, And according to an analysis of Treasury data by the Special Inspector General for TARP, after all of these resets are completed, the median monthly mortgage payment will increase by more than 20% for these families. Monthly payment increases will be even higher for those who needed the most help and thus received the steepest initial discounts in their interest rates. Now, researchers at Urban Institute's Housing Finance Policy Center have estimated that the impact of these resets will hit hardest in 2016 and 2017, and that as a result, we may see redefaults of about 10% among this group. That translates to about 100,000 families defaulting in the next couple of years. So, Mr. Meyer, I wanted to start with you. I was pleased to see that last week Treasury announced plans to enhance the existing HAMP modification to avoid some of the problems that these resets will cause. Has New Jersey Community Capital looked at ways to help these families stay in their homes if they default again?
Yes, Senator.
It's okay.
Yes, Senator. Thank you. We believe that it's important to engage with principal forgiveness and to make sure that the mortgage is right-sized to give the homeowner the best chance of success. But a really important part and an important component of our program is a really high-touch financial counseling component. And it's not just to develop a mortgage resolution plan to keep the homeowner in their home, but it's also on a go-forward basis. So our counselors are staying with the homeowner after mortgage is modified for a period of 12 to 18 months to make sure that they stay on track. And although our track record right now is 2 years, we have modified hundreds of mortgages and have not yet had one redefault.
Good for you. Thank you, Mr. Meyer. So I want to actually, though, ask about another part of this. I want to raise another issue, and that is when Fannie or Freddie owned mortgage goes into default, Fannie or Freddie buys the property and then resells it. And last year alone, Fannie sold more than $2.8 billion worth of property. So when these notes are sold to homeowners rather than to investors or absentee landlords, families do better, neighborhoods do better. So FHFA has a first look policy that gives families and individuals first crack at buying these repossessed properties before the bidding is opened up to investors. But the policy isn't working. The houses are priced so high during the first look period, significantly above market value, according to many reports that we hear, that regular buyers don't really have a shot at this. The prices come down only later when investors are moving in. So I thought I'd start with you again, Ms. Guzmán. As a realtor, you have firsthand experience with the difficulties that borrowers are facing in today's housing market. How do you think Fannie and Freddie could better ensure that these notes end up in the hands of owner-occupants?
Well, it's beyond the first look. I mean, getting a first look and then being able to submit an offer right away, also in a timely response on that offer, is completely different than first look, let the clock run out 10 days later, then it's a multiple bidding process. That seems, they say they want to support owner occupancy, but we find that it really kind of confounds everything. As I said, working with several buyers, it's been a multiple offer process. They're writing 5, 6 offers just to get into housing. The Vasquez family, with their 3 children, it ended up that we didn't even get into a Fannie Mae property. We actually worked with a private seller, and it worked out just fine. But the first look, it has to be more than first look. It has to be first look, first bid.
Good.
Give them a crack, and then after that, if it doesn't succeed, then fine, then go ahead and reintroduce it to the public and let the private market go at it. But it has to be first look, first bid.
Good. Thank you. Anybody else want to add on first look, Ms. Goldberg?
Excuse me. So our recommendation would be to extend the first look period longer, but also that any time the price drops, there should be a new first look period.
Interesting.
So that, once again, people who want to live in the home as opposed to use it as an investment have an opportunity to take a shot at it. And in addition, we would recommend that, that we remove the incentives for the preference for cash offers. So what we understand is that a lot of times the real estate agents who list these properties are paid incentives to move things quickly, which means that when you do get an offer and you get, two offers, one requires someone to get a mortgage, the other one is a cash offer. If you're going to get a bigger commission, if you move it quickly, then you're going to go for the cash offer that can settle immediately without having to worry about whether and when the mortgage comes through. But if we want to, as I think we need to do across the board with the foreclosed properties that are under the control of either government agencies or government-controlled agencies, or the non-performing loans, we need to be looking at these as resources to help stabilize communities. And our approach to disposing of those assets needs to both be mindful of the bottom line for the agencies involved, but also of the bigger neighborhood stabilization efforts that are really needed, because those help shore up all the other mortgages and all the other properties in those same neighborhoods. So making some of these changes to the first look process so that we don't create incentives for investors and cash offers to get a preference. We actually have a settlement with Wells Fargo as a result of some of our REO work and a complaint that we filed with HUD under the Fair Housing Act. And under that system, or under that settlement rather, one of the provisions is that anytime there's a cash offer, an offer that requires financing that's at least as good as a cash offer, the offer that's from the person who wants to live in the property has to get preference. And that's something we would recommend be instituted across the board.
I need to respond to that.
Respond, and then Mr. Meyer.
Because ultimately, when offers come in and they're cash and or if they're financed, we always recommend the finance deal because actually it's a better price. So we don't actually lean towards a cash investor ever. We want it to be
the real estate.
We the real estate, the realtors. I've represented REO properties for Bank of America, and I have friends who work on Fannie Mae properties as well. And what it comes down to is that the investor, that person on the end that you don't see, is making a decision to go with cash, even though we believe that the finance deal is a better deal. It's a better price, but they don't want to wait. They don't want to wait. They rather go ahead, especially in many cases, just go with cash because they figure it's going to be a clean deal, and that's it.
Same outcome.
Yeah. Mr. Meyer?
Senator, we have a fair amount of experience with the First Look program, both with Fannie Mae and also through the National Community Stabilization Trust. And our experience is that they need more time. It would be helpful. But we also advocate for a last look because all too often the price does come down and then it goes into an investor. They buy it, where that homeowner or that nonprofit could have purchased it. And I have an example of that. About 2 years ago, I was working with Fannie Mae on a bulk transaction. We were going to buy 40 properties in a very targeted neighborhood. And we thought it was an opportunity for us to really increase home ownership and also build neighborhoods. We couldn't get to an agreement on price. At the end of the day, they ended up selling it for less. They ended up breaking it up and selling it into the market, but the price kept dropping and dropping and dropping. And, of course, nothing good happens when these properties sit on the market vacant. So I urge that. I think another area, and I really do believe this, we entered into a direct sale with FHA. It was the first time ever done in the history of FHA to help with Sandy recovery. We purchased 517 mortgages. We paid a premium. The Office of Management and Budget, calculated that premium. But it was worth it for us to be able to get control of those assets, to be able to repurpose them for the community stabilization outcomes we thought important. Number one, keeping family in their home. And number two, when the houses were vacant, to be able to offer them to owner occupants and as an affordable housing opportunity. I would urge that that type of program continue to be developed both at FHA and FHFA, that they tighten the neighborhood stabilization outcomes to make sure that these properties do end up for community stabilization purposes.
Well, I want to thank you all for these comments. They're very helpful. I just think it's very important that the First Look program actually work to help keep homeowners in homes and to help stabilize communities, not, as you say, a box to be checked off before the property gets shipped over to investors. So thank you. It's really important, and I appreciate all the ideas you've got for how it is that this program could be changed to make it more effective for families and more effective for communities.